Hello, let's deal with part 2. And in part 2 of today's lecture, I want to look at the revaluation model IAS 16, how it works with IAS 21. So, if you remember, the IAS 21 rules for non-monetary items carried at historical cost, then you use the historical rate. What that means is there will not be any change in exchange rate, because if the one you um, recorded using 1:1 at the closing date, the reporting date, you still use 1:1 because it's non-monetary and it is carried at historical cost. And so you use the historical rate. However, if it is non-monetary, but the non-monetary item is fair valued or revalued, then on the date the revaluation is done, there is likely to be a different rate. So in that case, we have to determine the exchange gain or loss. And that's why what question 2 is about. Plain, which as a functional currency of Ghana cedi, accounts for land using revaluation model in IAS 16 PPE. On 1st July 2020, Plain purchased a plot of land in another country for 2.4 million dinars. At 30th June 2021, the fair value of the plot of land was 3 million dinars. Relevant exchange rates are as follows. Required. The requirement is to explain, guys. You are to explain, so you can't just put figures down and go. You must write what or explain what you are doing and use the figures to illustrate. So you have to start by saying the transaction must initially be recorded by applying the transaction date rate of 4 dinars to 1 Ghana cedi, and therefore the entity will record the land. The land will be recorded at 2.4 divided by the transaction date rate of 4, and that will be 600,000 Ghana. So this is what the figure we use for the double entry. So in terms of double entry, we will debit PPE 600,000 and credit payable 600,000, and credit payable, let's say credit cash. Here we were not told that it was bought on credit, so let's just assume that it was cash. Even if it's payable, you just know that your payable will be translated at the end of the year using the closing rate. That's fine. Now, this land has been fair valued, and so we get to 30th June, and then the land is fair valued. And so the rate on that date, since it's fair value, we will use the rate on the date of fair value to translate the fair valued amount. And here the fair valued amount is 3 million. So this same land, which came in at 4 dinars to 1, will now be translated to 3 million divided by 3. And so you're going to get 1 million. Please take your calculator and calculate this. You will get 1 million. Now it came in at 600,000. Now after revaluation, you have 1 million. And therefore there is an exchange gain of 400,000. Exchange gain of 400,000. Remember, if you revalue PPE, the revaluation gain is recognized in other comprehensive income, and therefore if there is an exchange gain, it will also be recognized in other comprehensive income because the standard says so. So you go into the standard and make sure you read this. And so um, you will recognize the revaluation gain and the exchange gain in other comprehensive income. So you are going to have to debit the land 400,000 and credit revaluation reserve through OCI 400,000, so that the land will increase, the PPE balance will increase from 600 to 1 million. Okay, and that's what will happen. Um, let's see how it will look like when you pass the journal. So here on 1st July, we convert the value of the land from 2.4 dinar at 4 to 600,000, and therefore we debit land 600 and credit payable or cash. If you if for any reason it's indicated that it was acquired on credit, then that's where payable will come in. Here you can assume anything, but just remember that if you assume payable, then at the end of the year you must also translate the the payable into using the closing rate at the end of the year. Now, and then because there was land which is fair valued, we fair value it by determining the value of the revalued amount in Ghana cedi, in the functional currency, and the rate there is 3. And so when we divide 3 million by 3, we get 1 million. Deduct it from the transaction date value of 600,000, we have 400,000 as our revaluation and exchange gain. Please, let's take note that it is both revaluation reserve and exchange gain. But what is important to note is they will both be recognized in OCI. So normally we don't try to separate them. They will both be in OCI. Another way you can, but if you want to know how to separate it, how much is revaluation reserve and how much is exchange gain, remember the 600 was already there. 2,400,000, 2.4 was already there, which we translated at 4. And so at the end of the year, that same 2,400 is translated at 3. And this gives you 800,000, 2,400,000 translated at 3, whilst 2 million, the same 2,400,000 translated at 4 gives you 600. So this is the initial of the 2.4. This is the fair value date rate, because now the asset is 3 million. That 3 million is made up of the original 2.4 and the increase. So the increase in the value of the land is actually 600,000 dinar. 600,000 dinar, because the initial cost is 2.4 dinar, which is now 3 million. 3 million. So that 3 million is made up of 2.4 and 600. And therefore the 600, if we translate this, we have 600. If we translate this, we have 800. So between the two, we'll have 800,000 minus 600,000, which will give us 200,000. And then remember the increase in the revaluation itself. which we will now recognize at 3 because that's the transaction day value, will give us 200,000. So it is this exchange difference of 200 and the revaluation gain of 200,000. That's giving us a total of 400, which will all be recognized in OCI. That is the point I want to emphasize. So you can just record the 400 in OCI and you'll be fine. But in case you want to know how much of the 400 is an exchange gain and how much is revaluation gain, then you may want to look at this breakdown. So that is it about revaluation. Now remember, it is an essay. So you must write an essay. Initially, transaction rate, and because it's monetary item, non-monetary item, normally it will not be translated if it's carried at historical rate. But since this land in question is carried at the revalued amount, it will be translated at that rate, and then the gain on the translation will be recognizing other comprehensive income because revaluation gains are recognizing other comprehensive income. So that is it for part 2. Thank you.